Hi, good day to all. This is Kelvin here again. Welcome to this week's latest edition of our weekly technical outlook on the major stock indices, where I'll be covering the latest key levels to watch and the trend bias on the SPX 500, the Nasdaq 100, the Hong Kong 50, the Japan 225, as well as the German 40 stock indices for the week of 18th of July to 22nd of July 2022. So before we start, let's take a look at the disclaimer slides first. All right. So let's take a quick look at the momentum performance and the momentum analysis across the globe from the major stock index, US indices, three Asia major indices, and as well as the barometer for the European stock indices, which is the DAX German 40 index. So as you could see that last week, all the major US stock indices, ranging from the SPX 500, the Nasdaq 100, the Dow Jones Industrial Average, as well as the Russell 2000, all of them actually staged a pullback last week. So the performance actually was actually pretty weak at the start of the earlier part of the week, from Monday to Thursday. But remarkably, starting on Thursday, especially on Friday, the intra-week losses were actually being trimmed by more than 50% on its stellar performance that was seen on last Friday. So in all, still not too bad. I would say that the weekly damage or the weekly pullback has been more or less been cut by more than 50% right from its intraday low last week. So the worst hit was actually the Russell 2000, which is down negative 4.1% among the US major stock indices, but not too bad. Later I'll share with you on the technical analysis chart on the SPX 500 and Nasdaq 100. You were able to know why. Okay, in the technical picture, it still remains the same. Okay, so but the worst hit was actually among the globe, among the major indices across the globe were the China-related stock indices, Hang Seng Index as well as the Hang Seng Tech Index, both down by close to negative 7 and negative 8%, negative 6.6% for the Hang Seng, and negative 7.7% on the Hang Seng Tech Index. So primarily there were two negative drivers that is driving this weak underperformance. Number one will be this risk of this system, we call it resurface of this systematic risk in the China banking system, primarily due to this unreluctant by home buyers to actually start to actually repay their home mortgages due to this unfinished or an increase in unfinished project by property developers. So all in all, it's actually number one, the main crux is due to this ongoing liquidity crunch that is being seen in the property developer, leading to unfinished project, now leading to homeowners refusing to pay their regular home payments, which potentially could start to see another round of, we call it, systematic risk that starts to actually stir in the China banking system. But nevertheless, last weekend we start to see PBOC starts to reinsure that there are actually going to be ample liquidity in the banking system, and they will actually start to actually provided targeted measures to allow these property developers that is facing because liquidity crunch to actually deliver their unfinished homes on time. So we should see how this week the Hang Seng Index and the Hang Seng Tech Index react to this negative news flow that was actually being floated over the weekend. All right, from PBOC governor that he made during a speech on last Sunday, one of the G2 panel meeting. And the Nikkei 225 actually performed fairly well, up 1.02% last week. In terms of this momentum analysis, is the strongest, but taking into the difference of last week performance and its prior 4-week average, which is at positive 2.15%. The German DAX index actually fell slightly last week, negative 1.16%. Right. Now, moving on will be the 11 sectors performance on the S&P 500 for last week. So all you could see is that last week almost all in the red, but towards the end of the week, we start to see a bit of outperformance. That means their losses has been trimmed down, especially by the consumer staples and the utilities. Both are defensive sector. Not too bad on the information technology, which is initially I think the loss is coming close to 1%, but it managed to trim it to actually end only last week at negative 0.3%. One of the reasons why is because of this US 10-year yield curve that is remains below 3%. Okay, that's helping the US information technology stocks. And the worst hit, oops, pardon me, let me go back again. The worst hit were actually related to the energy or commodities related sector, with the materials down negative 1.32%, the energy down negative 3%, and also last but not least will be the communication service sector, which is down negative 3.26%. All right. So now, without further ado, let's take a look at the technical chart of the various indices that I shared with you. So for the SPX, so SPX, right, the key intermediate resistance level or will be at this 3,945, which is this red line here. So we could see that it's also confluence with the 50-day moving average. So what we could see that this was last Friday performance. Okay, pretty remarkable. Ended with a bullish candlestick, and prior to that, we start to see a bullish dragonfly doji as well on Thursday. So what we could see a very strong, remarkable performance on Thursday and Friday that almost erased more than 50% of the initial losses that started on Monday last week. So all in all, right, it seems to me still pretty positive. So if you call that in 2 weeks ago, we still have that bullish bias to play that 1 to 3 months of corrective rebound to retrace certain portion of this major downtrend that was actually kickstarted in early January this year. So still no change. 3730 as my key medium-term pivotal support. Still looking for a further potential push up. Being gonna definitely it will be gonna be reinforced by a breakout of this 3945 upside trigger level. That was actually stated last week as well. So still no change. Looking for a breakthrough at this level potentially to take us up higher towards 4075. Maximum 4204 in these coming weeks. But however, if we start to see a 4 hour close below 3720, then we will start to see we call it it will invalidate this bearish scenario to see a further drop towards 3610 slash 3580, the major support zone of for the SPX 500. Now, moving on will be the Nasdaq 100. So you could see the Nasdaq 100 over here. Uh, no change. Still the intermediate support, intermediate resistance level towards with 12,180, which is this red line here. So what we could see over here is that last week performance also pretty sterling. What we could see is that last Thursday, especially last Friday, where it actually erased almost 50% of the initial losses that was actually seen on the early part of last week for Monday, Tuesday, and Wednesday. So definitely this red line here, this 12,180 will be the key upside trigger level to play this potential 1 to 3 months of corrective wave B rebound towards 12,960, then after 13,500. So the strategy for this week, right, is still the same, no change. So I will be still using 11,280 as my key medium-term pivotal support. A breakout above 12,180 should take us much higher towards 12,450, then followed by 12,770, the same resistance levels that we highlighted last week. So, however, a 4 hour close below 11,280, it will actually invalidate our bullish bias to see a further drop towards the key major support zone at 11,1097, maximum 10,675 on the Nasdaq 100. Then moving on to the Hong Kong 50. So what I see the Hong Kong 50 over here is that last week was actually it shaped this underperformance. But however, very interestingly, on last Friday itself, it started to shape this bullish doji candlestick. And what we could see this week, start of this week, very remarkable, strong push up by these two bullish candle, and it actually reintegrate back above this ascending trend line support of this we call it 3 months plus or 4 months plus of ascending triangle range configuration that is still taking shape since the low of 15th of March 2022. And also the 4 hour RSI has just exited from a its oversold level after hitting it on last Friday, which is it came very close to a level at 23%, which was the lowest since 22nd of April. So what it means that the last week of downside momentum has more or less been abated, and with this positive price action that was seen on last Friday and being followed through right at the start of this week, which is right now, reintegrating back above the ascending trend line support of this 4 month plus of ascending triangle range configuration. So all in all, what we could see is that last week push down is deemed as a failure breakdown or failure breakdown of this ascending triangle range support. So we'll be maintaining our bullish bias. So if we call that last week, we have a pivotal resistance, pivotal support level, pardon me, and medium-term pivotal support level at 20,470. So we will actually give a bit of access, tolerate a bit of access at 20,000. So what is 20,000? Is actually the swing low area of 19th of May all the way up down all the way to 26th of May 2022. Then looking for a push up in first step to this intermediate support, intermediate resistance at 21,300. So what's 21,300? Actually confluence with two graphical elements, the ascending trend line support that I draw from the top of 28th of June, connect it to the last two lower highs, and this previous swing low area of 24th of June to 7th of July 2022, which is coinciding or confluencing at this 21,300 level. So definitely this will be a key level in the short term, between 1 to 3 days. So a break above this 21,300 level should take us up for to see a further bullish momentum in the following days or the coming week towards this 20 towards the ascending triangle range top or range resistance that has kept previous we call it rebound that has taken shape since the formation of this ascending triangle from the low of 15th of March, which is the swing high of April 2022, 4th of April, and 28th of June 2022 at 22,640. But however, if we start to see a 4 hour close below 20,000, then we could see a further drop towards 19,165, and failure to hold above 19,165 may risk a further decline to retest the 15th of March swing low area, which is at 18,300, 150, 18,100 level. All right, so still maintaining that bullish bias on the Hong Kong 50 index, and we deemed that last week push down as a failure, bearish breakdown. All right, now moving on to the next Asia, we call it major Asia indices index, which is the Nikkei 225, or we call that as the Japan 225 in our platform. Is if you recall that last week we attempt to actually play a push up within this complex range configuration, which is at 27,500. Price action now coming very close to it. So I would say that our bullish bias has more or less been met its resistance slash target. So what's this level? Why is it so important? Because number one is this descending, pardon me, descending trend line resistance that is in place since its high of 14th of September 2021. Right. And bear in mind, if you look at the RSI, the daily RSI is also coming very close to a corresponding resistance at the 61% level as well. So for this week strategy is that we will decide to have a neutrality stance since it's coming very close to a key medium-term resistance level. So neutral between 27,280 slash 27,500, and the lower boundary of the neutrality range, the lower limit of the neutrality will be at this 26,200. So what's 26,200? Is actually this swing low area of 12th of June and 13th of June, and as well as this ascending trend line support that I draw from the 20th of June low. All right, so now acting as a support at 26,220. So neutral between these two level. So however, if we have a 4 hour close above 27,500, we could see a further push up in first step towards 27,860, followed by the 9th of June swing high area at 28,370. But however, a 4 hour close below 26,220 will see a push down to retest this swing low area of 12th of May and 20th of June, acting as a support at 25,535. So having switching to a neutrality stance on the Nikkei 225, given that last week push up is now coming very close to the upper limit of this key medium term complex range resistance. Then what we have next, lastly, will be the German 40 index. So if we call that the German 40 index last week, we still have a bullish bias above this key support level, which is the 7th of March swing low area at 12,430. So given that 2 weeks ago, it's more like a we call it access level. And on last week itself, it also did a early last week, it did actually we call it a big, a pretty lackluster movement, very similar to the US stock indices. But what you see last Friday, it managed to actually erase last almost 50% of the earlier week's losses that was actually seen at the early part of last week. So that's actually pretty positive on the German 40 index, given that it actually retested 12,430 again, being the third time. All right. So if you go to the weekly chart itself, let's go to the weekly chart. You will see why is it so positive, because it shaped another bullish weekly hammer pattern prior to the previous week, right at the 12,430 level. So all in all, right, what we could see over here is we're still maintaining that bullish bias on this German 40 index. If we go to the 4-hour chart, what we had last week is the 12,430 slash 13,385, which is the low of 5th of July, a bit of excess. So RSI still pretty bullish on the 4-hour RSI, previously shaping the bullish divergence, and right now is actually managed to actually hit above the 50% neutrality level, and has yet to reach this extreme overbought zone or extreme overbought area at a 75%. So all in all, right, what we are looking at in first step, to see a push up to retest this upside trigger level at 13,400. Right, but if we see a breakup above 13,400, then it will extend this further corrective rebound towards the next resistance at 13,680 slash 13,900. But however, if we have a kind of a daily close below 12,385, then we will cease to see the start of this new leg of, we call it major impulsive downward sequence again, to actually target the next support at 12,030, followed by 11,600, which is on the daily chart. Pretty much clear this level over here, which is the swing low of 15th of June to 29th of October 2022. So all in all, right, what we could see is that the overall the major indices, despite last week lackluster performance, but however towards the end of last week on Thursday, Friday, we start to see a remarkable recovery, which actually maintained our bullish bias across the globe for the US indices, the Hong Kong 50, as well as the German 40 index. So as we still maintain that bullish bias, except for the Nikkei 225, which is kind of showing a bit of a mixed element right now, since last week push up is now coming very close to a key resistance of its complex range configuration. So we actually remain neutral on the Nikkei 225 for this week. So with that, have a great week ahead, and I'll see you again in my next video.